Welcome to SB Talks. Today is Tuesday, September 24th, and I am joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing the US Fed's 50 basis point rate cut. Should we be worried? What does this mean for the Reserve Bank of Australia today, if anything? And Australia's Millennial Recession. Welcome to all our listeners. Let's start in the US this time around. There'd been huge anticipation for last week's meeting of the US FOMC. In the immediate days prior to the meeting, speculation quickly built that rather than the previously anticipated 25 basis point cut that we were going to get, we instead got 50. And should we be worried that they've chosen to start this cycle with such an aggressive cut?
Yeah, I did catch most economists by surprise. Most had penciled in 25, and the reason being is typically the Fed had only really started a rate cutting cycle with 50 when there'd been a crisis, like after the dot-com recession or the GFC or during COVID. So no one really thought there was a huge urgency. The economy in the US is growing at an above trend rate. So according to the Atlanta Fed's GDP now sort of pulse of the US economy, it's growing at about 2.9%, and so that's quite a strong growth rate.
And if you listen to Chair Powell and some of his statements immediately after the meeting, he again was trying to almost reassure that the economy was solid.
Yeah.
But the rate decision sort of tells a different story.
Yeah, so there'd been an article from the Wall Street Journal's Nick Timiraos, who is very close to the Fed, and often you get the sense that maybe things are leaked to him in advance to sort of prep the market. So he'd put out an article about a week before the Fed saying, well, 50 is quite possible. And basically the reason that was put forward was interest rates are restrictive at 5.25% to 5.5%. That's quite a high level. They didn't need to be as restrictive given that inflation's come down quite a lot. And that if the Fed was going to start cutting back towards neutral rate, so that's the rate at which neither is slowing down the economy nor speeding it up.
Neither on the accelerator or the brake.
That's right.
Yep.
Then just get on with it. Why dilly-dally and do these little 25 ones? Why don't you just, make further progress towards getting there more quickly? So that was the argument that was put forward in the article. And I think that's what obviously the Fed's decided to do.
What's your take when you look at we talk here all the time about being data dependent. What's your take on the trend in the data and how healthy or otherwise you think the economic situation is in the US?
I think the economy is still pretty good there. I mean, there's a few pockets of weakness. So, for example, last night we got the preliminary S&P version of the PMI for the manufacturing sector in the US. Which had showed a little bit of softness. So that fell from 47.9 to 47. So that's in contraction. So the manufacturing sector is struggling, and that's often a good sort of cyclical indicator. So there's little pockets of weakness. Obviously, we've spoken about the slowdown in hiring, and some of that is just due to fewer job openings, but also strength in the supply of labour. So that's pushed the unemployment rate up about 0.5% over the last sort of 6 months or so. So there's a few little things that the Fed is maybe a bit more concerned about, and they did say they're strongly committed to supporting maximum employment. So they've switched from inflation to the employment part of the mandate, and obviously they're a little bit worried that once the labour market starts to show cracks, then the unemployment rate can go up quite quickly. So they don't want to be behind the curve.
So very important there, obviously. They have a dual mandate. Yeah. Inflation has been the primary focus, but now they're saying, okay, well, if inflation's maybe not completely under control, but at least hopefully heading in the right direction, we have to keep an eye on the second piece, and maybe it's showing us some concerns.
Yeah, nothing too dramatic, but I think they just want to be ahead of it. But that said, we've had a bunch of Fed speakers talk after the meeting. Yep. So we've had Governor Waller, Goolsbee, Kashkari, Bostic, and Bowman, and they've all basically said they think the economy's broadly fine. They're not particularly worried, and they're going to be data dependent going forward. So I don't think there was anything too much that came out of it. I think they sold it pretty well don't get too concerned. We're just trying to take away some of this restrictiveness in policy.
Does that mean that you are still team soft landing?
Yeah, I'm definitely team soft landing.
Okay.
I think, actually interesting, one of the governors, Bowman, she was a dissenter last week. It's the first time a governor has dissented against a rate decision since 2005. She argued for a 25 basis point cut. And she said she didn't want to signal that the Fed has called, job done on inflation. She still thinks there are inflation risks. The economy obviously is still growing pretty strongly. And she's worried that inflation, it's not back at 2.
Yeah.
That there's still risks that inflation could be a problem and that the Fed might need to reverse course or...
Yeah. Well, a lot of this is a debate about, I guess, where is the neutral rate and also how quickly they get there.
Yeah.
So, she's arguing for let's a more measured approach and where they get back towards that more neutral territory versus the argument that you've just articulated, which is let's get on with it.
Yeah.
We know we're well and truly in restrictive territory right now. We're a long way from neutral and what might be debated to be neutral. So let's at least start getting in the right direction.
Yeah. Yeah, I think the other thing that's interesting is we got a new set of summary of economic projections. So they kind of lowered their inflation forecast a little bit, increased their unemployment rate forecast a little bit. Nothing too dramatic there, little tweaks. And also we got the dot plots. So that's the of the 19 participants on the FOMC, where each one expects interest rates to be at the end of this year, end of next year, end of 2026 and over the long term.
What did that show? Anything materially different?
Well, it shows that the median participant expects 2 more rate cuts by the end of this year.
Right, yeah.
Now, market's got 3.
Now gone to 3. Okay,
so we had 3.
For a while, we had sort of 1% before the end of the year. We're now, following the 50 basis points we got, we're potentially up to 1.25.
Yeah. So the market's saying there's a 50-50 chance that maybe the next rate cut, the next meeting will be a 50.
Again.
Yeah, right. Again. So
that will be aggressive.
Yeah, that'll be aggressive. But that plays to that theme, let's get on with it. So we'll see, and they've got basically rates getting to neutral by the middle of next year, and the longer term forecast for neutral is 2.9%.
Okay.
So a little bit below where people actually think it is because they feel like...
In the low 3s.
Yeah, the economy's done pretty well with high interest rates, so maybe rates don't need to go down that low to be neutral.
Don't really feel like we want to go into an ultra-low interest rate world again. I think we've worked very hard to get out of it.
Yeah, and the 10-year bond hasn't really moved at all.
I was going to ask you, so let's maybe step across from the economics to the markets. What's the impact been on the bond market in the first instance?
Yeah, not much actually. So it was all pretty well priced. Obviously, as I mentioned, the market had priced in, a good chance of a 50. So the 2-year bond didn't really move much, and neither did the 10-year. Because it's already rallied so much in the past, 3 or 4 months. So a lot of it is largely in the price. Yeah. And
let's talk equity markets if we can. Late last year, markets took off in a huge exuberance at the excitement of the rate cuts that were to come. Now, that was in a hope or anticipation that we were probably going to see them in the early part of this year. They've ultimately come in the back end of the year, but now they're here, and they're here with a bit of a bang. What's your take, I guess, in where you think how equity markets might respond to this? I appreciate we've only probably had about 2 or 3 trading sessions, probably only 2 trading sessions since it was formally announced.
Yeah, well, the S&P 500 did make a new record high, I think, late last week after the decision. So the market obviously liked it. It's tricky, Typically, when the Fed starts cutting rates, assuming it's not a recession environment, and it's a sort of soft landing kind of scenario like we have, it's good for equities. It's the best of both worlds because growth's still okay and rates coming down. So that's what you want as an equity investor. So that's typically what happens. I think the challenge this time around is that equity valuations are already pretty high.
Very much so.
So maybe they don't do as much this time around in the Fed cutting cycle as they have in past cutting cycles.
There's one of these often used lines, which is buy the speculation, sort of sell the fact when the news finally comes out. It's been quite soon from the markets. They sort of jumped around as the rate announcement was made, and we've had sort of a one positive day and then one sort of probably more benign sort of session there. But
so it's really
keen to watch this space, I think, given where valuations are at.
Yeah, I mean, look, I don't expect valuations to increase. Really what'll have to come through for the equity market to continue to do well is earnings. And earnings have been good. We've discussed it on the podcast before. US earnings in particular, pretty strong. They've grown 14% in the last year. Estimates for the year ahead are sort of similar, low sort of teens type growth. If they come to pass, then that'll be good for equities. But it doesn't mean that price-earnings ratios need to increase.
Yeah, I think that's probably, you're saying, their earnings that probably justify prices that we're potentially already seeing in the market.
Yeah. So as we roll forward, the multiple comes down, or the equity prices goes up and the multiple stays the same. So that's typically what we'll see happen. Yeah.
I'll bring it back closer to shore if we can. With the hype and speculation around the US now in the cutting cycle, everybody here waits with bated breath. Could the RBA be next? Fair to say we're not of the view that that's likely to be happening anytime in the immediate future.
No. I think the RBA has been pretty clear that a rate cut this year is not on their agenda. So we're obviously recording this before this afternoon's RBA meeting. Yep. I assume it'll be another on hold. The board will debate a hike probably or no change, and probably go with no change again. I think, when we look at, say, employment here, it's still pretty strong, So we had another strong growth in the number of jobs created in August. Almost 50,000. We had 60,000, almost 60,000 the month before. They're pretty strong job numbers. And that just confirms what the RBA is saying, is that, there's still a degree of tightness there in the labour market that's keeping wages growth, elevated. Productivity, they keep lamenting, is weak, and so
non-existent.
So when you have strong wage growth and no productivity, that's not good for inflation.
It's inflationary, certainly. Yep.
Yeah. So these are things that the RBA keeps talking about,
and worth remembering. We started later in our rate increases, and we didn't get nearly as far. We got to sort of 4.35, where the US got well over 5.
Yeah. And I've seen some economists saying basically they could see rates on hold for a long time, So most economists now don't have a rate cut this year. Some have it sort of middle of next year, first quarter, obviously data dependent. But the RBA could just stay on hold for an extended period, foreseeably, particularly if inflation gets stuck at around 3.5%. That puts them in a bind, really.
Very hard to
it's obviously not what the government wants.
Well,
it's election.
It's been a political hot potato. They're trying to put through some of these reforms of the RBA, and the Green Party, I'm sure you saw this week, came out with their statement that they're not going to support them until the RBA cuts rates. I thought.
Well, they want the government. They want the treasurer to use his discretionary power to force them to cut rates. So. Yeah, that's just the Greens grabbing headlines, But
it does raise a good point, because we were talking about it before, in that Australia, we certainly have, it's called a certain degree of economic robustness, but it's certainly not clear across the board. In fact, we probably have two very big cohorts in society, those that are, I could call it the savers and the borrowers. The savers are rejoicing after a decade of negligible interest rates. Now interest rates are back and life is good. But the borrowers are now... a lot of pain out there in pockets of the Australian economy.
Yeah, so Goldman Sachs put out a report last week called the Millennial Recession.
Right.
So they talk about the millennials, people aged 29 to 43, who have really had negative real income growth over the past 2 years of 9.4% in sort of, their ability to spend on discretionary items. And that's due to obviously higher cost of living, higher interest rates, bracket creep has been a real thing. So they've really retrenched on spending on discretionary items, whereas the boomers, people 59 to 78.
So most of our listeners, I'd suggest, yeah.
Have done well, higher interest income, and government transfers, so things like pension payments that are indexed, So they've their discretionary real disposable incomes only declined by 2.4% over the last 2 years. So there's big...
Taking a hit, but not nearly to the same degree.
Not nearly to the same degree. And the result is that spending in Australia, discretionary spending in Australia, has fallen 0.5% over the last year. And this is an economy where the population's grown 2.5%. So in per capita terms, per capita spending's gone back.
Reinforces
2.9%.
Reinforcing the per capita recession chat that we've had a few times on the podcast.
Yeah, so it's interesting. So they've, Goldman's have trimmed their GDP growth forecasts for the year ahead on the back of this work that they've done.
Right.
Yeah.
But I think it's sort of more middle of the road sort of path for Australia, probably for the immediate time ahead.
Yeah.
And we've talked on the podcast not too far distant past about sort of the rally in the Australian share market and the sort of the banks continuing to just kick on to spectacular highs. How do you think about that as a chief investment officer with your asset allocation hat on? How does that make you think about allocations to Australian equities in the portfolio?
Yeah, well, there's been a bit of rotation in the equity market away from those Mag 7 type growth companies to value companies, and more companies are seen as more defensive. And so Australia's been a little bit of a beneficiary of that. We're a value-driven market with banks and miners.
Not a lot of tech here, unfortunately.
But what that's meant is that these banks are now incredibly expensive relative to their history and relative to the rest of the world. And when you look at the market through that lens, you think it's overvalued. Like at least in the US, with 14% earnings growth, you can say, okay, well, they deserve a premium price earnings multiple. Australia has not quite as high as the US, but it's at high levels, and there's no growth.
Yeah.
The banks have like flat line growth, and the miners, given what's going on in China, don't have any growth either. So when you look at the market here, it's very hard to get excited about it. But as I said, it is a beneficiary of this equity rotation, and that might have further to run. So we're constantly looking at it.
Who's brave enough to bet against CBA share price? It seems relentless.
Well, absolutely. It's crazy. It's like a tech company.
Yep.
It looks like a tech company. The multiple it's trading 24 times earnings. And 3% dividend yield, or 3.5%. It's But
dare I say it?
But our
the boomers love it.
Well, the reality is a lot of the fund managers that we use are underweight those stocks, so we leave it to them to avoid CBA, and most of them have avoided it, or they can't bring themselves to buy it at those sort of valuation multiples.
The passive funds out there, still see plenty of capital flow into it. That's an excellent roundup. Thank you as ever, Nick. And thank you to all our listeners.
Thank you.